Chapter 1, Part 4, Goals of Financial Management. The integration of the external investor point of view with the internal management orientation is evidenced by the goal of financial management to make those decisions and engage in those activities that will maximize the overall value of the firm for the benefit of the stockholders. The goal of maximizing profits is not the same as maximizing shareholder wealth. The valuation approach to wealth maximization focuses on how investors value the future earnings stream. Shareholder wealth maximization is a long-term goal. Changing investor expectations and emphasis may influence its achievability. While not all managements focus on maximizing shareholder wealth, ignoring wealth maximization for publicly traded firms can result in hostile takeovers or institutional investor pressure on the board of directors. The goal of maximizing shareholder wealth cannot ignore corporate responsibility to social issues and cannot operate without ethical standards. Eventually, long-term abuse and irresponsible corporate social behavior will negatively impact the overall value of the firm. Ivan Boesky and Michael Milken, along with other insiding scandals, engage our interest. Martha Stewart is also a candidate for discussion. Most recently, there have been a number of famous hedge fund managers that have been indicted and convicted of insider trading. Balancing wealth maximization and social responsibility is very difficult. We will focus on the 3M Company as a way of showing that good management can accomplish both goals of wealth maximization and social responsibility. The role of financial markets really depends on the fact that wealth maximization is dependent on the perception and expectations of the market. Through daily price changes in the common stock of each publicly traded company, the market provides managers with what you would call a performance report card. The structure and functions of the financial markets, and we will discuss money markets in Chapter 7 and capital markets in Chapter 14, are more fully presented in later chapters, but students may find that some current examples from the Wall Street Journal can create a sense of realism about this course. Allocation of capital. You need to understand to know how the market price reflects risk and return expectation and how a company's ability to raise funds is influenced by its financial performance and its corporate behavior. It's important to realize that institutional investors have major influence on publicly owned companies. While this was touched upon briefly in the chapter in the area of agency theory, here we emphasize the power of these investors to force restructuring of public companies. Many examples will be included. When we talk about internationalization of financial markets, we emphasize that globalization of capital markets makes a worldwide pool of capital available to many companies. The international companies highlighted in the text will illustrate this point as we search for capital in the global marketplace. The Internet and technology has dramatically changed the way the capital markets operate. Technology is responsible for the rise in online retail brokers such as E-Trade and electronic markets that have put pressure on the exchanges to become more efficient. This has led to worldwide consolidations and restructuring of the world's bond and future exchanges. We think the next decade will continue this trend. I'm from the Boston area, and we used to have a Boston Stock Exchange, and through mergers and acquisitions, that no longer exists today. So this wraps up Chapter 1, and I'll see you again in Chapter 2.